There's a moment in every trader's life that never shows up on a chart. No indicator flashes, no headline warns you in advance, no expert sees it coming. One day the market is calm, liquidity is smooth, volatility is low. Everyone feels smart. And then, without permission, without warning, everything breaks. Prices gap, spreads explode, orders vanish. Your stop loss doesn't save you, your risk model doesn't protect you, and your confidence, the thing you thought was unshakable, collapses in seconds. We call these moments black swans, not because they are rare in history, but because psychologically we refuse to believe they can happen to us. Every trader thinks they are prepared until the day the market reminds them they are not in control. And when a black swan hits, the market doesn't just take money, it exposes illusions. Illusions of safety, illusions of predictability, illusions of intelligence. The most dangerous part isn't the loss itself, it's the realization that the rules you thought governed the market were never real to begin with. In this video, I'm not going to give you a list of black swan events. You can find those anywhere. Instead, I want to talk about something deeper. Why markets repeatedly destroy people who think they understand them. Why the biggest risks are always invisible. And why surviving black swans has nothing to do with being smart, and everything to do with how you see uncertainty. Because if you stay in this game long enough, you won't ask if a black swan will happen. You'll ask when, and whether you'll still be standing when it does. I still remember the first time I experienced a black swan. It wasn't dramatic on the news. There were no breaking alerts, no countdown. I was young, confident, and convinced I had finally figured the market out. My system was working, my risk was controlled, my equity curve looked clean, and for the first time I felt something dangerous, comfort. Then, one morning the market opened wrong. Price jumped, liquidity disappeared, orders slipped. Positions that were supposed to be safe moved faster than my execution could handle. By the time I reacted, the damage was already done. I didn't blow up my account that day, but something more important broke. My belief that markets behave rationally. Up until that moment, I thought risk lived inside my charts, inside my indicators, inside my models. What I didn't understand was that the real risk lived outside my assumptions. Later, I would see the same pattern again and again. In 2008, in flash crashes, in currency pegs breaking overnight, in funds collapsing despite perfect strategies. Different instruments, different eras, same lesson. Black swans don't attack your strategy, they attack your worldview. They arrive precisely where confidence is highest, where leverage feels justified, where risk feels manageable. And retail traders suffer the most, not because they are careless, but because they are taught the wrong things. They are taught that the market can be mastered, that risk can be quantified, that uncertainty can be modeled away. But markets don't punish ignorance, they punish certainty. And once you understand that, you start to see trading very differently. The mistake most traders make with black swans is not technical, it's philosophical. We like to believe that markets are complicated, but ultimately knowable. That if we collect enough data, test enough strategies, and follow enough smart people, we can reduce uncertainty to something manageable. That belief feels rational, it feels professional, and it feels deadly. The real mistake is assuming that risk is visible. Retail traders are trained to fear the things they can see: a bad setup, a losing streak, a volatile session, a news event on the calendar. But black swans don't live there. They live in the blind spots created by comfort.
They live in assumptions that go unchallenged because they've worked for a long time. They live in periods when volatility is low, correlations look stable, and everyone agrees on what is normal. That's why they hurt so badly. Before every major black swan, the market is calm. Confidence rises, leverage increases quietly. Risk feels cheap. People aren't reckless, they're rational based on the world they think exists. Then something breaks that was never modeled. Liquidity evaporates where it was assumed to be infinite. Correlations flip exactly when diversification is needed most. Stops become irrelevant because price doesn't move, it teleports. And when that happens, the pain feels unfair. Traders say the market was manipulated. They say it was impossible to predict. They say nobody could have known. All of that may be true, but the deeper truth is this: the market didn't betray them, their mental model did. Black swans don't punish bad traders, they punish fragile ones. Fragility is not about skill, it's about structure. It's about building a trading life that only works when conditions remain familiar. It's about needing the world to behave in a narrow range for survival. When your success depends on stability, uncertainty becomes lethal. That's the pain most retail traders never diagnose correctly. They think they lost money because of bad timing. In reality, they were exposed to a reality they were never prepared to face. The turning point doesn't come from predicting the next black swan. That's another illusion. It comes from realizing that prediction was never the goal. At some point in your journey, you stop asking, "What will the market do next?" and you start asking, "What happens to me if I'm wrong?" That question changes everything. When I finally understood this, my entire approach shifted. Not just my strategy, my relationship with uncertainty. I stopped trying to be right. I stopped optimizing for smooth equity curves. I stopped trusting models that only worked in calm environments. Instead, I began to think in terms of exposure. What am I exposed to if liquidity disappears? What breaks if volatility explodes? What assumptions am I making that, if violated, would destroy me? This is the mindset shift most traders never make. They treat black swans as rare accidents. Professionals treat them as inevitable features of complex systems. Markets are not machines, they are ecosystems, and ecosystems don't fail linearly. They fail suddenly, disproportionately, and without regard for fairness. Once you accept that, trading stops being about control. It becomes about resilience. You start building systems that can survive surprises. You stop chasing maximum returns and start prioritizing longevity. You respect uncertainty instead of trying to eliminate it. And quietly, without realizing it at first, you cross an invisible line. You stop being a trader who reacts to markets and become one who can endure them.
What most people misunderstand about black swans is not their size, it's their nature. They don't come from randomness, they come from structure. A black swan is not an unpredictable event. It's an event whose consequences are wildly underestimated because the system was fragile long before it broke. Markets don't collapse because of one shock. They collapse because stress has been quietly accumulating under the surface. Leverage builds where returns feel easy. Liquidity is assumed, not tested. Risk models extrapolate yesterday into tomorrow, and then a small disturbance hits a system that can no longer absorb it. This is why black swans always look obvious in hindsight. The signs were there, they just didn't matter, until suddenly they mattered more than anything else. Take the Swiss National Bank shock in 2015. For years, the CHF peg felt unbreakable. Central banks don't lie. Currency pegs don't fail overnight. Volatility was low. Carry trades felt safe. Retail traders loaded positions. Funds scaled exposure. Risk managers relaxed.
Then, without warning, the peg was removed. In minutes, liquidity vanished. Stops were skipped. Prices gapped hundreds of pips. Accounts went negative. The shock wasn't the decision itself. It was the systemic dependence on stability that turned a policy change into a massacre. Or look at March 2020. The virus was real, but the collapse wasn't about health. It was about leverage. Risk parity funds assumed diversification would protect them. Correlations were modeled from calm decades. Volatility spikes were considered temporary. Then everything sold off together. Stocks, bonds, commodities. Assets that were never supposed to move in the same direction suddenly did. Liquidity providers stepped back. Margins were called. The market didn't fail because the virus was unpredictable. It failed because the system was optimized for efficiency, not resilience. Smart money understands this. They don't try to forecast black swans. They structure their exposure around the assumption that something unseen will eventually break. They limit leverage not because they are conservative, but because leverage converts uncertainty into fatal risk. They diversify across failure modes, not asset classes. They accept underperformance in calm markets in exchange for survival during chaos. Retail traders, on the other hand, are taught the opposite. They are taught to maximize returns, to optimize entries, to increase position size when confidence is high. They are rewarded for smooth periods and destroyed when the regime shifts. This is the fundamental asymmetry of markets. The upside of being right is linear. The downside of being fragile is nonlinear. Black swans exploit that asymmetry ruthlessly. And this is why most retail traders don't fail slowly. They fail suddenly. Not because they were careless, but because their strategies were built on assumptions that were never stress-tested against reality. Once you see this, you stop fearing black swans as monsters. You start seeing them as diagnostic tools. They reveal what was never robust. They expose hidden dependencies. They punish systems that demanded certainty from an uncertain world. The real edge isn't predicting the next crash. It's designing a trading life that doesn't need predictions to survive. That's the difference between people who disappear after black swans and those who quietly stay in the game long enough to benefit from them.
What changes after you truly understand black swans is not your strategy. It's your behavior. You stop asking how to win faster. You start asking how to last longer. In practical terms, this doesn't mean becoming fearful or passive. It means becoming intentional about fragility. You begin to see leverage differently, not as a tool for growth, but as an amplifier of error. You realize that leverage doesn't just magnify returns, it magnifies assumptions. And when those assumptions break, leverage ensures you don't get a second chance. You also stop placing blind faith in diversification as it's commonly taught. Owning many assets doesn't protect you if they all depend on the same conditions to function. True protection comes from asking what fails together and designing around that. Risk, in this mindset, is no longer a number. It's a narrative, a story about what happens to you when the market behaves in ways you didn't imagine. So you trade smaller than your ego wants. You accept periods of boredom instead of chasing constant action. You leave room for surprises, not because you expect them, but because you respect them. And slowly, your relationship with the market becomes calmer, not because the market is safer, but because you are no longer demanding certainty from it. This is where most traders feel like they're moving backward. Returns look modest, progress feels slow. There's nothing exciting to show off. But beneath the surface, something important is happening. You are building anti-fragility. You are designing a system that doesn't collapse when reality deviates from expectation. You are learning to survive uncertainty instead of fighting it. And in a profession where most people are eventually erased, survival itself becomes an edge. Black swans are not warnings. They are reminders. They remind you that the market is larger than your models, that history doesn't repeat, but it does humiliate.
that confidence, when left unchecked, is often the most dangerous position you can hold. If you take one thing from this video, let it be this. The goal of trading is not to predict the future. It is to remain standing when the future refuses to look like the past. Every trader who lasts long enough eventually meets a black swan. The difference is not who avoids it. The difference is who is structured to survive it. If this perspective resonates with you, stay with this channel. Not because I promise certainty, but because we talk honestly about uncertainty. Leave a comment about the moment the market humbled you the most. Subscribe if you want to keep exploring what really separates those who disappear from those who endure. Because in the end, trading is not about mastering markets. It's about mastering yourself so you can survive whatever the market becomes. Master yourself. Master the markets.